On board, Kulin Lalbhai, director at Arvind Fashions. Kulin, hi, good morning. Good to have you on the show. How is it that your first quarter fared versus what you did last year, same quarter?
Quarter one has two particular things which are impacting both the revenues and the earnings. One is something which we had already indicated a quarter before, which is that we have decided to exit 4 brands. And these brands were brands where we felt that the scaling potential of the businesses, the underlying businesses, was not that large. So to optimize the capital for the company and to bet on the large scalable concepts, we decided to exit these brands. So there is a one-time exit cost of these brands, because whenever you exit a business in retail, you have retail stores, inventory, and other things which need to be written off. So there's a one-time write-off that we have this quarter, which is different from any other quarter of ours. Secondly, if you look at the results, the growth in our power brands looks low. And here, I would just like to de-average it. Inherently, the actual growth in our power brands is closer to 12% growth, which in the current consumption environment is quite a strong performance on growth. But what we see in the reported numbers is actually a negative growth on power brands. And that is because we have decided to kind of do lower primary sales in one channel, which is what we call the multi-brand outlet channel. And this is a channel of smaller stores where we sell through distributors. And we have seen that the secondary sales in this channel have been showing a downward trend. So the company has decided to take a slightly conservative view and feed this channel a little less. We have decided to sell less primary into this channel. It's in a sense a one-time kind of correction of inventory.
Where is it that you're seeing maximum pain, Kulin? Which brands or segments would you say were the worst hit in the last 3 to 4 months?
I don't think there is a specific trend. I think the stronger brands which we have, even in a weak market, a relatively stronger brand would perform better. So, you have a Tommy Hilfiger, US Polo, Calvin Klein. These are all strong brands, Frying Machine. They are all more established brands. So they would weather, in a sense, a tougher market a little bit easy. I think newer concepts would find the going relatively a little harder.
Okay, and how many more Unlimited stores could see closure? And are you looking to exit any of the other brands as well?
I think as far as the Unlimited structuring is concerned, it's already complete. There are some overflow stores into quarter 2, but that is marginal. So I would say the Unlimited restructuring in that sense is complete. Even the brand exits, as you would have seen in the result, we are exiting 4 brands where we did not see a huge growth potential in times to come. So that's a one-time cost and a one-time exit for the company. The remaining portfolio is a portfolio we are excited about and committed to. And now that we have freed up resources, we'll be able to put those resources behind these exciting opportunities like a Sephora, like a Gap, like an Innerwear, which are all growing rapidly.
So what are the key categories that you're going to focus on once the consolidation period is over? And when do you think we can see a tangible improvement in your earnings starting to reflect?
I think the portfolio which we have is strong on its earnings profile. Some of the drag brands have gone out. Some of the loss-making network has also gone out. So I think the remaining portfolio is strong on profitability, and once the trade channel stabilizes, you will see that the underlying business is actually strong on profitability. The growth drivers for us, of course, will continue to dominate, and we do dominate the casual wear segment. But the new segments of growth for us are the beauty segment with Sephora. We are growing strongly in the innerwear segment. We are growing strongly in the kids segment. So these are all growth focus areas for the group.
Right. You'd also outlined about the center of gravity shifting away from stores to mobile phones. About 80% of your buys are happening online. How is it that you're leveraging this opportunity?
Actually, online has been a very high growth segment for us. We have actually grown more than 50% year on year for many, many years. It's now 17% of our business. And the great thing is, because we are strong on casual wear and casual wear dominates online, even if you look at the brand ranks in all the top portals, our company dominates the brand ranking as well. So it's a very strong part of our business. And our own omni-channel now.com is also scaling up very well. In times to come, it should become, it is becoming a large part of our online business. And a good segment of our customers now shop with us both online and offline. And those customers tend to spend a lot more on our brands. So I think we are very well set on our omni-channel journey, and it's scaling up very well.
Okay, so getting closer to the festive season, how would you say that the sales are doing at the moment or likely to shape up over the next few months? Any guidance that you can give us?
It's very difficult for me to give any guidance as of now. All that I can share with you is that July has been weak, and the hope is, as the festivals come close, there will be some sort of revival in demand. But it is very difficult to hazard a guess in this environment on how strong the momentum would be when it would come. So as of now, we are focused on efficiencies and making the most in a tough market.
All right, we wish you all the very best. Arvind Fashions currently down 8%. A quick glance as to what the mood is for the markets as well at the start of